U.S. stocks gyrated to a mixed close on Friday as investors headed into the long Christmas weekend after digesting cooler-than-expected inflation data that firmed bets the Federal Reserve will cut interest rates next year. The Dow dipped fractionally, while the S&P 500 and NASDAQ each gained about 0.2%. All three indexes notched their 8th consecutive weekly gains, the longest weekly winning streak for the S&P since late 2017. The benchmark index is now within 1% of its record close reached in January of 2022. Breaking that level would confirm the S&P has been in a bull market since a low hit in October of that year. But bumpier times could be in store, says Philip Colmar, managing partner and global strategist at MRB Partners.
The market's been rallying for weeks now on really exiting 2023 on the back of optimism around the Fed and its pivot towards an easier policy. And so while I think that that's been positive, a lot of this Goldilocks scenario is now in the markets, both in the bond market and the equity market. So opening 2024, probably going to be choppier as we start to digest that.
In economic data, the Commerce Department's Personal Consumption Expenditures, or PCE report, out Friday, showed inflation continues to ease down toward the Fed's average annual 2% target, reinforcing the belief that the central bank could begin cutting rates as early as March. In company news, shares of Nike tumbled 12% after the sportswear maker trimmed its annual sales forecast due to cautious consumer spending. Piers Foot Locker and Dick's Sporting Goods shed 2.7% and 3.9%, respectively. And Karuna Therapeutics soared nearly 48% in the wake of Bristol Myers Squibb's agreement to acquire the drug maker for $14 billion in cash. U.S. markets are closed Monday for the Christmas holiday.
Nike shares tumbled Thursday, dropping around 11% in after-hours trade. The slide came after the sportswear giant cut its sales outlook for the year. It now expects revenue to grow around 1%, when it had previously predicted growth in the mid-single digits range. Analysts had also expected a much stronger number. At just under $13.4 billion, second quarter revenue also missed estimates. Nike blamed cautious consumers. The firm said it was seeing a reluctance to spend in markets around the world. In the key Chinese market, sales have slowed as the economy showed signs of stalling. It's all forced Nike to do more promotions, which eat into its profit margins. The company plans a range of new products to revive consumer interest, saying innovation would be key to overcoming a sluggish market. The firm also said it was looking for $2 billion in savings over the next 3 years. Among other steps, it will cut some management layers and increase the use of automation.
Toyota shares slumped Thursday as the auto giant faced a deepening safety scandal. The problem originates at subsidiary Daihatsu. On Wednesday, it said it would stop shipments of all vehicles indefinitely after a safety inspection uncovered irregularities. An independent committee found issues with 64 models, including 24 sold under Toyota's brand. The investigation began after Daihatsu admitted in April it had rigged side collision safety tests. Daihatsu said Wednesday it didn't know when it would resume shipments and warned the impact on earnings would be substantial. Analysts said the damage to Toyota's earnings would likely be limited given the carmaker's size. The bigger impact could be for Daihatsu's suppliers, with a supply chain in Japan made up of more than 8,300 companies. Japan's government criticised the firm and said it would consider penalties. It said it could go as far as revoking the carmaker's production certificate. Daihatsu said it would consider financial support and damages for its suppliers. Separately, Toyota said it would recall 1.12 million vehicles worldwide, mainly in the US. It's to fix a faulty sensor that could cause airbags to not deploy as designed. Shares in the firm dropped 5% Thursday.
Foreign investor interest in Ethiopia's telecom sector is cooling, experts say, after a bumpy first 2 years for Safaricom, the only company so far granted a license to compete with state-owned Ethio Telecom. Ethiopia solicited bids in 2020 for the country's first private telecoms licenses. and the sector initially attracted interest from a range of major operators. But security problems and concern about the government's commitment to opening up a tightly controlled economy are deterring possible investors. Potential fiscal incentives have failed to materialize. Last month, regulators suspended the process to issue a third telecommunications license after potential investors said the conditions on offer needed to be improved. France's Orange told Reuters it had withdrawn from the process to buy an up to 45% stake in Ethio Telecom. Safaricom said it had signed up 7 million users, including 4.1 million active customers, over the past 3 months, after launching its network in October 2022. But according to a Western diplomat and an industry insider, who both spoke on condition of anonymity, one major struggle for Safaricom has been getting equipment through customs. One source suggested it was an example of the government favouring Ethio Telecom at Safaricom's expense. Safaricom, owned by the Kenyan government, South Africa's Vodacom, and Britain's Vodafone, did not comment on this point, nor on the specific challenges it faces in Ethiopia.
U.S. stocks closed lower on Wednesday after an abrupt mid-afternoon nosedive, ending an impressive rally driven by falling interest rates and the Federal Reserve's dovish turn. The Dow shed 1.3%, while the S&P 500 and Nasdaq each lost 1.5%. During the session, the S&P got within 0.5% of its all-time closing high. Reaching a new closing high would have confirmed the benchmark index had been in a bull market since hitting its bear market floor in October of 2022. The index is now more than 2% below its record closing high. Stocks have rallied on the back of the Fed last week, signaling it had reached the end of its tightening cycle, while opening the door for rate cuts in the coming year. Still, Ross Mayfield, investment strategy analyst at Baird, suggests caution for 2024.
We still think that even if the Fed is cutting rates, the floor under rates is much higher than it was in the previous cycle. That raises the bar for company performance and profitability. I think sticking with a quality tilt across sector, across asset class, whether in fixed income or equities, is going to be something that's really important over the next couple of years.
In company news, shares of General Mills slid more than 3.5% after the packaged food company cut its sales forecast. FedEx shares slid 12% after the delivery firm missed quarterly profit estimates and cut its full-year revenue forecast. Rival UPS dipped 3%. Alphabet gained more than 1% after the company announced it was restructuring Google's ad sales unit. And memory chipmaker Micron Technology, which closed down more than 4%, gained 5% in after-hours trading after forecasting quarterly revenue above Wall Street estimates.